the ultimate thing is that if you look at this, I mean, the US may well win the trade war. That's entirely possible, but it isn't necessarily going to win the capital war, and the capital war ultimately is more important. So the Fed, should be acting, but it should be putting financial stability way ahead of anything else, and it should be adding liquidity to try and stabilize markets. And that's just not a temporary phenomenon. That's something that's got to be underway, I think, permanently, because the whole financial system is fragile, as we know. And we learned that lesson to our great cost in 2008-9, and it hasn't gone away, I'm afraid. You've still got this shadow banking system, which is very highly leveraged, maybe 50, 100 times to 1 in terms of leverage. And, things can spiral out of control really, really quickly in that. So if debt is going to double in the next 10 years, then you're going to be seeing a doubling of the gold price. So it's going to be, nearer $7,000 an ounce in 10 years' time, rather than where we are now.
Hi, everyone. I'm Maggie Lake, and today I'm talking macro with Michael Howell, Managing Director at CrossBorder Capital. Hi, Michael. How are you?
I'm good, Maggie. Good to be here. Awful lot going on in markets right now again.
Oh my gosh, there certainly is. So how are you feeling about the state of the world right now?
Well, I must say, I've always thought that this year is likely to be a year of volatility. But, having said that, I mean, nothing like we've seen. It was always going to be tough because liquidity conditions were basically topping out. That was our anticipation. But, the Trump trade bomb has basically, created disarray everywhere. And I think, we're just sort of recoiling from that, basically. But, ultimately, I mean, markets will stabilize, but we've just got to try and assess the direction from the short term, I think.
Yeah. So I think one of the things that's making that really hard is right before I jumped on with you, I listened to someone say that they saw good buying opportunities here in U.S. stocks based on the declines we've seen. And another person saying this year feels like the dot-com bubble and great financial crisis all wrapped into one. And they're expecting declines of 35 to 40% from peak to trough. It's like you can understand why investors are confused. It's like, which one is it? I mean, it's sort of head spinning. Based on what you're seeing, how are you thinking about this? I mean, do you fall into either one of those camps, or is the truth somewhere in the middle?
Well, the answer is actually I've probably fallen into both. I think if you look at the way that US investors have shifted portfolios in the last even 3 or 4 weeks, I mean, they've basically gone hugely risk off in a way that we haven't seen really since the COVID crisis back in 2020. So there's been a real shift out of risk assets. Now, if you calibrate that, and we've got data on asset allocation going all the way back to 1978, so a long time here, there's only been about 8 or 9% of periods when asset allocation has been actually more conservative or more risk off than we are now. So on the basis that, is this a great buying opportunity? Are you buying when others are fearful, to use the sort of the Warren Buffett adage? The answer is yes, you are. Will you make money in the short term? That's difficult to say. And I think that, that rule normally applies with a time frame of about 18 months. So if you buy blindly during these panics, you can make money pretty much guaranteed on an 18-month view. But, on an 18-week or 18-day view, then the jury's out. It may or may not transpire. And that really comes down to the other dimensions. So the way that we think about markets is really in 2 ways. One is, how are risk assets basically being deployed, or how are portfolios being deployed in risk assets? And the other thing is, what is the flow of new money or liquidity into markets or into investor portfolios? And if the first one of those factors is, let's say, positive in terms of people have already gone hugely risk off, so the old saying, if you're lying on your back, things are looking up, and that is pretty much correct, I suppose. The other thing is, what is the flow of liquidity? And that's very problematic. Now, as we speak right now, it's not bad. And I think that, had we seen, less liquidity, markets would have been off a lot more, given the reaction to investors. But they've held up, actually, I think, surprisingly well. And a good benchmark of that is to look at what's happened to Bitcoin. I mean, I think it's a great surprise in many ways that Bitcoin has been robust during this period, or pretty robust. Okay, it's off from its highs, but it could have been a lot lower given the swing sentiment. So I think that's a fairly good bellwether that liquidity conditions are not that bad. And in fact, they've gone up for liquidity's expanded for 3 reasons. One is that the dollar has weakened, and that's normally a very good heads up to say that liquidity is likely to expand. People tend to borrow more money in dollars during that period. The second thing is that the People's Bank of China has been injecting quite a lot of funds. Now, this is not really an overnight phenomenon, but this is something that's been underway pretty much over the last 3 months. And they've injected something like 4.5 trillion yuan back into their market. So you're talking about sizable, you're talking about what, $600 billion or so, which has gone in. So these are, important flows of money. And then the third thing is really to look at the Fed itself. Now, the Fed has not necessarily been sitting on its hands in terms of its actions. It's been sitting on its hands in terms of its words, but in terms of what's been happening, money has been flowing into the US market. And if you look at the data, there's been something like 750 odd billion, which has been going in through the Fed balance sheet since the end of last year. And about half of that, 370 billion, has actually gone in since the end of last month. In other words, through the month of April. Now, those are sizable amounts of cash, and they come really for temporary or probably technical reasons, and largely associated with the fact that we've got a debt ceiling in the US. So the Treasury General account has been drawn down. That's an account on the Fed balance sheet, and effectively money has been drawn out of that account and gone into the money market. So it's helped to support things. So the money markets, although they've seen strain, viz the repo spreads blew out last week, they've actually come down to more normal levels recently. So I think we've got stability as we speak, and it's not surprising that the markets are trying to bounce from here. The big question is, what happens to that liquidity picture as the year unfolds? And that's where I think there's huge uncertainty. There's uncertainty about what China's going to do, although I would suspect that the Chinese are going to continue plowing this course of trying to stimulate their domestic economy, and they'll be adding more liquidity. And I think that's something they have to do, but, hey, we'll see. The other thing is, what is the Fed doing here? And that's why I think it's really puzzling. And the trouble with the Fed is it's really trying to operate two levers at once. One is an interest rate lever, and the other is a balance sheet lever. Now, the balance sheet lever is all about financial stability. The trouble is it gets muddled up with the other levers. So the Fed is sort of circumspect about whether it should be cutting interest rates or not. And you just listen to the number of different noises or voices that have come out of the FOMC in the last week or so about saying, will they cut, will they not cut, will they support, will they not support? It's all kind of confused in a way. So you've got that backdrop, and with inflation uncertain, are we in an inflation or a deflationary market after the tariff hike? I would suspect it's going to be deflationary because it normally is, but you can't rule out the fact that prices will go up in the short term. So to use Jay Powell's wonderful expression, it's transitory. But then you've also got the economy, which is likely taking a big hit from this. So the Fed, should be acting, but it should be putting financial stability way ahead of anything else. And it should be adding liquidity to try and stabilize markets. And that's just not a temporary phenomenon. That's something that's got to be underway, I think, permanently, because the whole financial system is fragile, as we know. And we learned that lesson to our great cost in 2008-9, and it hasn't gone away, I'm afraid. You've still got this shadow banking system, which is very highly leveraged. You've got hedge funds, which are engaged in, basis trade, to use that expression, which is a highly leveraged trade, maybe 50, 100 times to one in terms of leverage. And, things can spiral out of control really, really quickly in that. So the Fed needs to be alert and needs to be able to expand its balance sheet if necessary. And that's the way that I see it. So, I would say that there's that uncertainty hanging over markets, what they will do. And the problem is, and the reason I'm sort of hesitant about this, is that we know from experience that the Fed is always late. And as a result, it makes a mistake. And that's what we can't afford to happen this time, particularly if there's a conflict against China.
Is there, do you think that, what do you think's feeding into the Fed being so reluctant? Is it because they got so burned on the inflation front before? Is it because there's so much political uncertainty? Is it because there's political pressure? It doesn't seem like there's a lot of, in the past, we had the Treasury secretaries right there in the White House with the Fed officials and everyone working off the same page. We know from all of the, personal accounts of the great financial crisis, there was no space between everyone when there was that danger. There seems like there's an awful lot of daylight between the Fed and White House officials right now. What's contributing to the Fed being so reluctant in this? They surely must see what you're seeing.
Yeah, I think all of the above, actually. I mean, all these things are sort of creating confusion or chaos. And I think it's very difficult for the Fed to steer a true course. But I think on top of that, I mean, I think there's also an institutional, sort of problem here, an inertia, because, the Federal Reserve has come up with, or invented new fire tenders after the GFC, but they're not really manning the watchtower as far as I can see it, if you sort of draw that analogy.
Mhm.
They're not really monitoring the fire as it's smoldering. They're saying, okay, we've got the fire tenders, we've got the standing repo facility around, we've got a discount window that banks can come to if they're in distress. But then SVB didn't go to the discount window. So, accidents can happen. And I think that at the end of the day, what they need to be monitoring pretty closely, a lot of the tensions in financial markets, and looking at things like why the move index of bond volatility, is so high, is so elevated. That's got to be brought down. And also, why the repo spread blows out. Now, we've been flagging the fact, well, if you go back, over the last 15 months, you've seen a series of blowouts in the repo markets of the repo spread, and something like 90% of those blowouts have actually occurred since last August.
Mm.
So you can see that there's a concentration near term. But if you drill into the data and you look more closely, you'll find that actually 90% of that 90% has occurred pretty much since the end of January. So you're looking at a big concentration of repo blowouts, suggesting that liquidity conditions, even before the trade bomb was lit or exploded, there was a problem. And that's why I think the Fed needs to get to expand its balance sheet and start thinking about, let's not call it a QE, because there's so much
Mhm. I'm sure they'll
caught
think
up
of
with the
another
whole expression.
acronym.
But,
Nobody
but
wants to
let's
say
think of a
QE.
better acronym. Yeah, let's
Yeah.
call it QS, quantitative support. But ultimately, in a debt-driven world, which we're in, rightly or wrongly, we're in a debt-driven world. We've got to accept it. You need balance sheet capacity to roll over the debt. And the whole liquidity cycle that we look at and we emphasize is really a debt refinancing cycle. And it fluctuates with the maturity of the average maturity of debt. And that's what we've got to accept. So the Federal Reserve needs to nurture this, because it's really the Federal Reserve that controls that debt refinancing process.
I can imagine, why are we having, what is causing those blowups so frequently now? It sounds like it's kind of, a heart attack warning, and you're getting all these palpitations and you should really be paying attention to them. Why is it speeding up? What's happening behind the scenes? And I'm asking because I can imagine that if the narrative is, oh, it's hedge funds levered, you hear that, and it reminds me of what we heard leading up to the great financial crisis, was like, let them fail. Let those greedy SOBs who are, gambling, let them flame out. Who cares? This is, we should be focused on the working person. I can hear echoes of that again. Why is it happening? And is it because of hedge funds? That might not
Yeah,
be well in
yeah,
Washington right now.
absolutely. Well, I mean, the hedge funds are a symptom of the instability in the system, and the hedge funds are basically leveraging mainly in the Treasury market. Now, the problem that you've got, I mean, all these words are, I mean, what I would endorse. I mean, what we should be doing is bailing out Main Street, not Wall Street, every time. But the reality is that Wall Street has to be bailed out. And the end of the day, what really matters to the Federal Reserve and, of course, to the Treasury is the integrity of the US bond markets. I mean, this is the sovereign bond market is really what these financial institutions are there to preserve, and they've got to be preserved. So when push comes to shove, it's all hands to the deck and making sure that the bond markets are stable. Just look for an example of with the British sovereign debt market, the gilt market, during the time of the Liz Truss moment. The Bank of England turned from QT policies to QE policies overnight with alacrity, without sort of even any acknowledgement. But that's what they had to do. And when it comes to these crises, central banks have to act. And you could hear the head of the Boston Fed on Friday saying, well, okay, if markets do become illiquid, we're going to act. Well, okay, that's fine, but why wait until the event? Why not actually smooth the situation to provide liquidity? Because that's really the issue that is in front of us. Now, why is liquidity or lack of liquidity a problem? It comes back to this whole debt problem. And like it or not, as I say, we're in a debt-driven world. Long gone are this sort of textbook model where, capital spending attenuated by interest rates drive the business cycle. That's not the world anymore. We're in a world where financial markets are geared up to debt refinancing. We've got huge, pool of debt overhanging us, but debt has to be repaid, or more particularly, more correctly, it has to be rolled over. And it's that rollover which always creates tensions. So if you're talking about, a stock of debt of 350 trillion worldwide, and you said, for example, there's a 5-year average maturity on that debt, you're talking about 70 trillion of debt being rolled over every year. So this is a huge amount of debt or capacity for the financial system to cope with. And if they don't cope with it, you get a refinancing crisis. Now, the issue that we face, which is in front of us, is that number one, the liquidity bubble, if you like, which was elevated after the GFC, was elevated hugely after COVID, basically was there to support debt refinancing, and it did. On top of that, a lot of debt was turned out during the COVID crisis when interest rates were virtually zero. So in other words, debt has been shifted back into 2026, 27, 28, and it will come back into the system to be refinanced then, at a time when liquidity conditions are a lot less generous. And those days of abundant liquidity that we saw, in the wake of COVID, etc., are starting to dissipate and slow down now. And they're going to start to meet this debt refinancing wall in the next year or so. I mean, it may be even be coming through now at the margins. And that's what's causing the problem, the system to seize up. So you always need this liquidity injection, particularly when there's a huge amount of debt coming forward. Now, to crystallize that, let's look at Scott Bessent. Scott Bessent has an eye-wateringly, huge challenge to face this year, because he's got to refinance something like he's got to refinance about 9 trillion of US debt, Treasury debt, and he's also got to somehow finance another 2 trillion from the deficit. So these are big amounts to think about. And it's a problem if you're losing control of your debt market. And this is the outcome, I think, the conclusion that the world is basically taking away from the Trump tariff bomb. That's the reality. The dollar has sold off, okay, for sure. I don't think that's so necessarily, I mean, it's clearly material, but I don't think that's people giving up on America per se, as a lot of the commentators say. What I think is the more worrying thing is the loss of control of the Treasury yield. And what you're looking at is a situation, as we know, the yield on the 10-year is pushing up again. It's pushing up, it's trading above its 200-day moving average, where everybody is now saying we're about to hit recession in the US. Well, the Treasury yield should be falling during that period, not rising. It should be well below its trend, and it should be signaling the fact that investors are moving into safe assets. But that's not the case. And if you look at term premia, which is, I know, a wonkish concept, but it's the critical one to understand bonds. Term premium, which is the risk premia for holding interest rate risk on a sovereign bond, term premia are rising, and they've been rising pretty consistently over the last 6 months or so. And that's a worrying dimension for Scott Bessent. He can't afford that because the cost of debt goes up. And the issue is that if you're refinancing so much debt this year, that debt, a lot of that debt was taken out at much lower interest rates. So if you're refinancing at a higher interest rate, you're embedding a higher interest cost into the budget. So your debt burden is compounding the whole time. And that means the debt GDP ratio just starts to run away. And that's clearly not an attractive situation, because the only way out of that is you've just got to monetize. And that may be the ultimate solution. It probably is the only solution.
I want you to explain that for people who may not understand that. But are they losing control of the bond market? Are yields going up because people are not interested in owning treasuries, or there's not the dollars in the international system? There's not enough liquidity for them to be able to buy them, or both?
No, I don't think it's the latter. I don't think it's a question of the dollar being there being a shortage of dollars. I mean, you would see that in terms of the currency as well, but you're not. You're seeing the opposite. People are shedding dollars at the margins anyway, And as I say, I don't want to overegg that because I don't think it's a big structural pull away from the US dollar. I think it's a much more cyclical move. Now, if you come back to the Treasury market, that's a more worrying dimension. And if you look at what I said, they're losing control. They're losing control in terms of looking at a term premium. And what you don't want to see is term premium during a market, let's say a bond sell-off, starting to push up because it's saying that investors are demanding a bigger and bigger premium on yields or on bonds to hold them. Now, if you drill into that and you say, well, okay, what could be happening here? You actually look at it globally and you find, well, actually, term premium globally tend to be moving up. It's not just the US. But the worrying part about that is that if you look at the transmission mechanisms, the US is no longer a price maker in international bond markets. It's much more a price taker. And I say that by looking at the data over the period since 2020. And during the period from 2020 onwards, it's been very clear that term premia in other sovereign bond markets, in the Bund market, in the JGB market, even perhaps in the British gilt market, also in the Chinese government bond market, have been leading the move in US Treasury term premia. And that's the worrying thing. Now, if you've got the term premia in other markets pushing up, and after all, we've got Germany's debt brake being released, we've got Japanese inflation, which is well above people's expectations, so term premia in the JGB market's going up. And then you've got China, which is likely to embark on a major fiscal splurge. Then you've got pressures pushing up term premia and yields in the US. So this is not a great background for Scott Bessent to operate. Now, I've thrown another spanner into the works, or I think, as you say, a wrench into the machine or whatever. But if you look at that, that is China mischievously selling treasuries to maybe try and worsen the situation for the US. And let's not say they won't, because they will. This is a war situation. China understands that, and China will make it as difficult as possible. And what you're seeing, right now is a situation where China is sitting on $760 billion worth of US treasuries. They're unlikely to add to that. They're only going to take those treasuries down, presumably, and they're going to be opportunistically selling. Now, what better than to try and sell through a year where you can do it, as I say, mischievously and cause the US yield on the treasury market to spike upwards? And maybe that's what they're doing. And seemingly, at the same time, they're switching those treasuries into gold bullion. So the gold bullion price is going up. So they're basically telling the world, look, the new safe asset is no longer the US Treasury bond. It's gold bullion, a bar of gold. And so far, that's working pretty well.
Which is a very different scenario than we've been in a long time, and one that hard to imagine they accounted for. Maybe they did in Washington, but it seems unlikely that a trade war, they'd start a trade war while that was, with that as a likely outcome. Is there a risk that the U.S. would actually default? Because that's how that, if you have an unsustainably rising yield, that's what normally you would worry about. Is that anything that seems remotely possible?
No, there's no way that the US would default. There's no way that any major economy would default on their debt, because they basically can always monetize. They can always print money. So there's always a way you can sell debt. The question is what price can you sell it at? So we're not really debating about the US defaulting. We're really saying what is the yield base that they're able to sell their debt at, and that really is the issue. So the ultimate thing is that if you look at this, I mean, the US may well win the trade war. That's entirely possible, but it isn't necessarily going to win the capital war, and the capital war ultimately is more important. And if you've lost control of your sovereign debt market in this way, you're not really starting out very well in terms of winning that capital war. It's clearly a challenge. And that's what Scott Bessent needs to get to grips with. And it may well be that, as we saw last week, the threat of 4.5% yields on the 10-year treasury, the benchmark treasury, was enough to draw a line in the sand, and, Trump backed off. Maybe that was the catalyst. I don't know, but it would make sense. What they don't want is a disruptive treasury market. And
Is there a scenario where the trade war cools down, but the capital war doesn't, now that everyone's spotted weakness?
Yeah, well, I think it's all about a capital war, and I wrote a book with that name
And your
4 or 5
Substack is
years ago.
called that.
Exactly. And because this is what it's about. It's not really about trade wars. It's about capital wars. It's about making sure that American capital is still dominant. And, that makes tremendous sense. That's what the administration should be doing. And that's ultimately what they're trying to do. They're trying to get control of capital. They're trying to encourage more FDI, foreign direct investment, to open up on onshore US. That makes tremendous sense to me. And they're trying to make sure that the dollar is preeminent as a major currency. And I think they'll win out on that. But it's going to be a hard struggle in the near term if you've got a lot of debt to refinance, which is the reality.
What is the downside or the fallout or the price you pay of winning that capital war? What do they need to do, and what happens? I mean, is there any casualty to that? It seems like there has to be.
Well, I think the ability to win is really the ability to have a stable sovereign bond market, and that really, that's in many ways the most important thing. And if you look back through history, and I'm talking about sort of millennia of history, go back to the Romans or whatever, we can always say that the most important price in every financial market is the price of the dominant economy's sovereign debt, and that's effectively the yield on the 10-year Treasury. So that's critical. But if they lose control of that, that's indicative of, if you like, a loss of US power. Now, how do they get out of this mess? I think in the short term, the only route that Scott Bessent's probably got is to monetize the deficit. Now, they can do that sort of indirectly. They can do that by issuing a lot more bills. He said he was never going to do that because that was the policy he criticized for Janet Yellen. But the trouble is that he's been painted into a corner. So he may well be doing that. And if you've got the Chinese mischievously selling sovereign debt at longer maturities, and he's lost control of the long end of the market, then it makes more sense to try and go for the shorter end, finance there, and he will get, or presumably there'll be pressure put on J Powell to try and cut interest rates. But that, opens up another debate about, how independent is the Fed, and should the Fed be independent in this environment? We know during crisis times that the Fed and the Treasury do come together and work closely. And maybe this is the time when they should be doing that. But ultimately, what you've got is a situation where you're moving towards greater monetization. But in many cases, I mean, that's the only way out anyway. It's very difficult if you've got a whopping budget deficit, where you've got spending which is running away. And we know, from what Scott Bessent's already told us, there's nothing wrong with the revenue side of the US economy. You're still collecting 18% of GDP in taxation. It's the spending which is gone out of control because Medicare, Social Security, defense are just skyrocketing in terms of their outlays, and it's very difficult to control. So the only way you can do that is either cut them back, renege on those promises, or try and find innovative ways of funding. Now, it may well be that they can square the circle. They may say, as part of a deal with the so-called 75 countries that have approached the White House, the part of this deal that you're going to do with us is, in return for a security guarantee, you use the dollar and you buy US Treasuries. Now, the 75 may not be big economies, but you add them together, and this is, clearly a big start, and it may be an approach. The other thing they can do is to encourage the banks to buy more Treasury debt. That's a possibility. Getting rid of the supplementary leverage ratio is a start in that regard. But, ultimately, the Federal Reserve has got to come back and help stabilize the market, in my view. The problem is that these things are, or ultimately lead to monetization. And I think we come back on this path time and time again, which is why the gold price is going up in many cases, because monetization is the flavor in many economies worldwide. It's not just the US that's doing it. I mentioned China earlier on. China is monetizing. China has to monetize a lot more. We're in a debt-driven world, and the only way out of a debt-driven world is to monetize debt. So this is what we face. And I think if you look at the dynamics of the gold market, there's a very interesting, sea change going on there that maybe many people would have noticed, not just the rising gold bullion price, but it seems like the price is being set more and more in China. And, traditionally it was the London gold market, which was really king, and it set the gold price. I mean, that's been a feature since, like many things in Britain, since the 19th century. But now it looks like the Shanghai gold exchange is really the marginal pricer. And you can say that because, for a long time now, there's been a premium on the Shanghai exchange relative to London, which is telling you that there's always an Asian bid in the market. And we know that in March and in February and in January before that, the PBOC, the People's Bank of China, were net buyers of gold. They're buying bullion. But it may be part of a strategy, and this is what we've aired as well, that what China is trying to do is to get out of its debt problem by devaluing against gold. And that makes perfect sense to me. They're not devaluing against the US dollar, they're devaluing against gold. And that's a way of digging out of your debt trap because you're devaluing against real assets. We wrote a piece about a year ago which said, look, if China's going to get out of debt, its debt trap, it needs to devalue the yuan significantly against gold. It needs to get up to, gold needs to go up to $26,000, sorry, 26,000 yuan, bit ahead of myself, 26,000 yuan per ounce. And, where is it now? It's 23,500 as we speak. So it's getting up there, but it's doubled since the beginning of the price has doubled, more than doubled since the beginning of 2023. So the gold price is going up. Now, if you start to think, what does this mean? And if China decides that it's not going to devalue the yuan against the dollar, and why should they? They've still got a whopping direct trade surplus anyway, even as we speak. So there's no need to do that. The yuan is very competitive, too competitive. So if it sticks where we are, 35 or 730, you triangulate a 26,000 yuan gold price into US dollars through that cross rate, you're talking about $3,600 an ounce. And that's what I think is a pretty minimum target for what the gold market could do. And these are the new safe assets that people are going to be increasingly holding.
Is there a limit if everyone's now decided either gold is the only safe haven, and or this is how I'm going to deal with my debt problem? Is there any limit of people's ability to do that? If can other countries look at that, and is there some natural limit to the market? I mean, it's a finite resource, right? Is there some at some point does that become an unsustainable move in and of itself?
Well, it's not necessarily unsustainable. I mean, it clearly is inelastic. As you said, it's a finite resource. And what you're going to get is the price is going to keep going up the more bidders there are. But we've seen, persistently in the last, 20 years, buying from the so-called BRICS and BRICS and Friends group, those countries that are supposedly rivals to the US or the West, have been progressively buying gold. This has been a long-term strategy. It's accelerated recently, but it's accelerated really in the wake of this tariff or these tariff tensions. But it's always been there. So you've seen this process going on. We've got to remember that China's the world's biggest gold producer, and they've been encouraging their citizens to hold gold for several years now. And what's more, the Chinese government, the administration, is buying gold bullion. And these are all, I think, very important signals. So they're trying to say that gold is an alternative asset, maybe an alternative settlement asset in time to the US dollar. It will bedrock an alternative monetary system. And that's the way I think we're going. So, think of gold, but also think of Bitcoin, because Bitcoin is also, a finite asset. And interestingly, the two tend to move in the long term together, with Bitcoin, as we know, in the last 10 years being an even stellar performer. So, these are the sort of assets that people have got to hold in a monetary inflation. And we are in a monetary inflation world because, debt is there, and debt can't be got rid of that easily. It's got to be monetized away. And, if you want a sort of a straightforward statistic, look at the US debt burden, or how the debt burden has increased since year 2000. The stock of Treasury debt, marketable debt, has increased by almost 10 times in size since year 2000. Okay, now that's courtesy of COVID et al. GFC, we know. Those are the issues, but the debt stock is out there and it's 10 times bigger. What has the gold price done over that time? It's gone up almost exactly 10 times. So gold has matched the match the increase in debt, but that's basically a monetary inflation response.
I know we'll get some people saying, "Oh, does that mean we're going back to some sort of gold standard that we dropped?" I mean, what does that mean if now that's one of the only? And we'll get to Bitcoin and sort of that whole area in a minute, because I think that's super important. But and we have so many people, retail investors in the US who don't have exposure to gold.
Yeah, well, I think my answer is they should. And okay, we're buying it as a spike, but then look around the gold, the sort of gold universe. Think about silver or platinum or other precious metals. I mean, those are the whole case still applies. Generally, gold may be spiking. Wait for it to pull back and then buy it again. But you've got to think about the trend here. The trend is important in all these various monetary inflation hedges, and they're moving up because debt is being monetized, and that's the only route out. And I think, as I say, if China is opportunistically and mischievously selling treasuries to bid the yield up, then the only thing that Scott Bessing can do is actually fund at the short end of the market. And that funding at the short end of the market is almost automatically a monetization of debt. So these are the issues that one has to confront. Yeah, I mean, I think people should be owning gold. Now, to come to your question about, is this a gold standard? No, it's not. A gold standard would be very different from that. A gold standard would be fixing the price of gold. And so what that would mean is that if the dollar gold price shot up, there'd be a massive tightening by the Federal Reserve. That's not happening. It's very interesting that, back in the early 1990s, and you can actually see this, you can evidence it from the gold price chart, that the Federal Reserve was almost certainly deliberately targeting the gold price. In fact, Alan Greenspan used to say the first thing he demanded of the Federal Reserve when he got there every morning was to ask, what is the gold price and what is the US corporate spread? And by those two indicators, miraculously, he managed to work out the tempo of the economy and what he should be doing. But those were pretty important variables. But if you look back at the gold market through, I think it was 1994, 95, that 1 year or 15-month period, the gold price was absolutely stable. And in actual fact, a former FOMC member told me that fact. Well, they actually were deliberately targeting the gold price at that time.
So Bitcoin is interesting because you're sort of saying this is something that you think people are going to also look at as in the category of gold. So you buy this idea that it works as a hedge, as a sort of form of digital gold.
Yes, I think it does. The issue with Bitcoin, and we wrote several pieces on this, which are actually in our Substack. But if you look at what drives Bitcoin, it tends to be three things mainly. One is, or these are the systematic influences on Bitcoin. Number one is global liquidity, which is the biggest impact, and that's well over 40% of the drivers. Then you've got the gold price itself. Now, the gold relationship with Bitcoin is complex. Sometimes gold will have a short-term negative effect on Bitcoin, but ultimately in the long term, it tends to be positive. So what you could say is in the short term, very short term, gold and Bitcoin are negatively correlated, but in the long term, they're very positively correlated. So it's a slightly complex relationship. And then the third factor is investor risk appetite. Now, gold doesn't really have that in its factors, or it's a very small component, but Bitcoin is quite big. And that really attests to the fact that if you've got a big sell-off in NASDAQ, Bitcoin will fall as well. But equally, if you've got a rise in NASDAQ, Bitcoin will go up. So you've got that element to take into account. So Bitcoin is not a pure play or alternative liquidity play like gold is, but it has a big impact. Liquidity has a big impact on Bitcoin.
Yeah. There seems to be, when I hear people talk about it, and it's always been interesting that many of the people who are in the hard asset camp, if you want to call it that, who believed that, we're moving this way because of debt, and that is one of the ways to protect and hedge against it, are usually anti-Bitcoin. They usually see it as, they just don't buy into its promise as that, and they don't see it, and they see a lot of trust issues in that entire ecosystem. Are we working through that, or is that still something that stands in the way of it actually working as a proper hedge?
Well, I think it is a hedge, and I think it works pretty well. But there's clearly a lot of complex issues going on there. But ultimately, this is what I mean. These are assets that people have got to start to look to increasingly in the future, if not already, in terms of hedging what I would say is a long-term debt problem the world has got. And to come back to the point, it's not just the US has got that problem, Europe has got that problem, Asia's got that problem, and they're going to have to get their way out of it. And China is trying to dig its way out now. And part of the reason we were thinking that China has to expand or has to devalue the yuan against gold is that China needs to expand its liquidity dramatically to get the debt liquidity ratio more or down and more stable in China. And we come back to part of our thesis is that it's not the debt GDP ratio that matters so much. In other words, you can say, well, look, Singapore's got a debt GDP of 400%, but that still seems quite stable. China may have 300%, but it's had that for several years, if not decades. So why should it matter? What really matters is not debt to GDP, it's debt to liquidity. So when you have an absence of liquidity relative to the debt, you can't roll the debt over. And that's when you get a financial crisis. And therefore, what you need to do is to expand liquidity. So the fact is that you always got to start with the premise that is debt expanding or debt contracting? The trouble is that the world we live in is that debt is expanding. Politicians will only kick the can down the road. They're not going to vote for big spending cuts because they'd lose their votes, lose their seats. So they're always going to come at this with the idea of let's continue the status quo. So debt's always expanding. Therefore, you always need liquidity. And if you need liquidity, then you need these monetary inflation hedges. And that's the reality. This is a long-term view, not a short-term one.
Yeah. We have a debt problem. We have a demographic problem as well, which is contributing to this debt. We have a lot of older people that need taking care of. I've heard some interesting conversations about sort of, securitizing assets or tokenization of assets. We heard little things here and there in the administration as they've kind of embraced the whole crypto ecosystem. People were talking about revaluing gold, but maybe digitizing it. There's all these things being floated, stable coins. Do you see a way out through any of some of these new financial innovations that people are talking about?
Well, I don't know if they're a way out, but I mean they're going to be part of the architecture. I think in the future. I mean, stablecoin. I think absolutely, definitely, you need stablecoin, and therefore that there's a market there, which is beginning to open up in the US already, as we know. So that's definitely there for the future. Is it a solution? I don't think it's necessarily a solution. It's an alternative. In other words, if people buy a stablecoin, the stablecoin issuers may well invest in treasuries. But then, then you've got to say, well, okay, how do you square that circle? Simple being that people would, rather than put money into a money market mutual fund, they buy a stable coin. So the stable coin issuer is buying the treasury, not the mutual fund. So, it doesn't mean you're not getting any more buyers. You're just putting it in a different form. So I don't think there's any net gain there, but it does mean that this system is more, I don't know, maybe more liquid in the sense you've got an instrument which you can trade more quickly.
In this whole scenario, we haven't talked about equities at all. What happens to equities in a capital war scenario that you just painted?
Well, I think in terms of the overall market, let's look at the overall market, then get down to maybe what happens to sectors. And I think if you look at the overall market, basically equities tend to hold their own or their head just about above water relative to a monetary inflation. So if you've got a monetary inflation which is going on relative to an expansion of debt, so let's say that debt's expanding, and let's use the US as an example. Debt's likely expanding in the US at a rate of about 8% per annum, okay? So then you've got to say for stability, and we assume we're going to get stability because that's what the monetary authorities are there to achieve, you get 8% liquidity expansion in the medium term. Therefore, that's your benchmark against which to gauge asset allocation. Now, against that 8%, then you've got to say, well, if I hold cash instruments or I hold government debt, are they going to give me an 8% return? Well, the answer is in Scott Bessent's words, I hope not, because otherwise he wouldn't be able to fund the deficit if it was 8% yields, or certainly that easily. So in actual fact, what you've got to see is a situation where yields are below that 8% threshold, which means that bonds and liquid assets are not going to be a great investment. And it may well be that some form of yield curve control is enacted, which basically keeps yields suppressed in some way. And that's quite feasible, I think. Therefore, equities should do at least 8%. Some sectors will do better than that. And then you've got monetary inflation hedges, which basically will do at least 8%. But things like gold may do better and Bitcoin may be better because they've got a scarcity factor embedded in them. You know that the Chinese et al., other governments are buying gold. So that means that you've actually got an extra bit on top of that 8%. and then you know that Bitcoin is a scarce asset with no more supply, and you've got almost an S-shaped growth take-up of people actually buying Bitcoin increasingly in their portfolios. So that should be at a premium too. So you can see that these monetary inflation hedges should do rather better, but the benchmark that people have got to take is something like an 8%, an 8% level, and they've got to ask themselves which assets are going to deliver more than an 8% return. Because if they deliver less than that, I'm losing out. And I would say, equities will probably do on average about 8%. Things like technology should do better because they always do. You've got financials which are basically respond to the yield curve. So financials may be okay if you've got a steep yield curve. Then you've got cyclicals, and cyclicals already depend on the tempo of the economy. So that's another issue. But the average must be around that monetary inflation level.
It sounds like bonds are, I mean, we have people, if they're still hanging on to that 60-40 mix in the US, we know that there were a lot of questions about that, but the truth is a lot of people have been still operating that way. That sounds like that bonds are not a positive thing to be in, or uninvestable, as some people have said to me, in this kind of environment.
Well, I think that's right. I mean, I think that they are. I mean, I'm not going to deny the fact that if there's a recession in the US, the bond market would probably respond pretty well. But if you're going to play the bond market, my plea would be do that in the mid-duration area rather than the long end, because the long end, I wouldn't be confident of yields dropping a lot. I may be wrong, but because they always do, of course. But I may be wrong. But what I'm saying is that the environment at the long end may well have changed. You go for the safety of the mid-duration area. If you believe there's a recession. So bonds will perform temporarily during that period, but we're talking here about the long term. And the analogy that I've often drawn, which is, let's put it this way, it's an uncomfortable analogy, but it's an analogy which, has a certain resonance to it, is to go back to the 1920s and think of Germany. In Germany, we had a hyperinflation, in the wake of World War I. And a lot of the wealth, or most of the existing wealth in Germany, was held by older generations who basically invested in bonds. And through that hyperinflation, the value of those bonds was completely eroded, as we know. So that older generation lost out. The younger generation bought equities, which were a relatively new instrument at the time. And they were scolded by their peers or by their elders who said, why are you buying these crazy things, this new technology? They're just speculative. You're not going to make any money. You're going to lose your shirt in that. The answer was they lost their shirt by owning bonds, whereas the younger generations with, let's say, unfortunate consequences looking forward, were the ones that got the wealth, and they were the ones that had the political power in the system as the 1920s unfolded. So there was a huge wealth transfer in Germany in the 1920s during that hyperinflation. Now, I'm not suggesting in any way that we're going to go through a hyperinflation in the US, but we're moving into a monetary inflation of, maybe high single figures. And you've got to think about that same analogy and extending it. It means that, bondholders are not going to lose their shirt overnight, but they're going to be sort of progressively sandpapered to death, which is an equally uncomfortable prospect. So I would be reducing exposure to bonds, and I would be holding gold or even, monetary inflation hedges. You've got to recognize that prime residential real estate is a very good monetary inflation hedge as well. Bonds, sadly, are not. Bonds will hedge against recession, but that comes. Those are sort of few and far between in many cases. So you've got to think about the longer term. And the other point, which I ought to stress, is the distinction between monetary inflation and high street inflation. The two are not the same thing. What we've had in the course of the last 30, 40 years is huge monetary inflation. The value of the paper dollar has been eroded, evidence that by looking at the gold price. I mean, that's clear. My point is that the gold itself per se doesn't change in value. What happens is everything else devalues against it. We're just accustomed to saying that the gold price goes up, but gold is like the pole star in the sky, which navigators look at to guide them, on the oceans. And gold is the same thing. It's a benchmark of value, but it's a hedge against monetary inflation, not necessarily high street inflation. High street inflation is a cocktail between costs and monetary factors. And if you get cheap Chinese goods or you get technology breakthroughs, costs will change. And equally, that can work the other way. So if Chinese cheap goods are not allowed in or tariffs spike, you're going to get a lot of high street inflation. You might not necessarily get monetary inflation, although I bet you probably would at the same time.
That's a really, really important distinction because I think people only look at the sort of high street, main street. Are my eggs up? Is my, like that sort of basket of goods and use that as a gauge of inflation. It's very interesting that you bring up that Germany comparison at the time and the switch generationally from bonds to stocks. Do you think that generational opportunity is in Bitcoin?
Well, I think I draw the analogy, and I've used that analogy before, Maggie, to say, look, okay, isn't this what many of the older generations are saying about cryptocurrencies right now? And cryptocurrency is a big universe, the same way as the stock market is a big universe. And I'm sure in Germany in 1922 there were companies that failed. There will be cryptocurrencies that fail, but generally the stock market in Germany, kept up with inflation. That's how you preserved your wealth in Germany. It was a nominal asset. And the same with Bitcoin, it's a nominal asset. So what you find is that if there's a monetary inflation, Bitcoin will go up in the long term. I'm not an expert on Bitcoin or any cryptocurrency, but all I can recognize is that if you've got an asset that people believe in that's got a fixed supply, it will basically give you a hedge against monetary inflation, the same way that gold does. People decry gold. I mean, you read the Wall Street Journal and the Financial Times every day, and they say, this is a dumb asset to own, barbarous relic or whatever the label they put on it. But who's laughing? Them or people who have been owning gold. The gold price has gone up dramatically in the last. What is it up this year? 25% or something.
Which has a lot of people concerned about chasing it. We've kind of been like, oh, it's moved too much. I've missed the boat.
Well, the old adage is the markets never go in straight lines. I mean, that's for sure. So you've got to think about a pullback, but just look at the trend here. And all I'd say is that let's think about the analogy I drew earlier on with US debt. If US debt is growing at 8% per annum, it's doubling every 10 years. Sorry, a big one. If it's growing at got that right. Maths is correct. If it's growing at 8%, it's doubling about every 10 years. So if you take that analogy, then you've got to say that the stock of debt is going to double in the next 10 years. It doubled from year 2000 to 2025. Sorry, it went up 10 times between year 2000 and 2025, and the gold price went up 10 times. So if debt is going to double in the next 10 years, then you're going to be seeing a doubling of the gold price. So it's going to be nearer $7,000 an ounce in 10 years' time, rather than where we are now. And that's broadly how it works. But silver is lagging gold. Silver may be an interesting one to take a look at, but it's equally a monetary inflation hedge.
Earlier this year. You were in Asia. You did a trip to Asia. I'm curious what your thoughts were when you came back, because I know you were talking to people and meeting people. And what were you thinking about when you came back about what's going on in that part of the world that we may not be aware of sitting over here?
Well, I think the thing is, I think the first thing to say is that it was a fairly broad trip of Asia. But one is that there's, every time I go there, I'm always impressed by wealth levels and how affluent the region generally is. And I think you can see that, not just in Asia, but also in, if you can call them satellite countries like Australia. It's probably more obvious to us Brits because Australia was an offshoot, obviously, from Britain at one stage. And Australia was always thought to be a sort of a poorer country. And now it's massively richer than the US, per capita, than the UK per capita. And in terms of standard of living, there's no comparison. So you've got this continual drift. And I think that's all to do with the fact that Asia is generally an affluent and prosperous region. So I think that's true. If there was an issue about, were they discussing the tariff issue at the time? No, they weren't. This has suddenly hit us. So I don't think anyone was anticipating quite the speed with which the tariff bomb would be set off. So at that stage, people were kind of uncertain about the year, but they were not wary about, and they were not alert to the tariff threat so quickly. But I think what you're seeing from the evidence, the feedback I get from our clients in Asia, is I think a lot of Asian investors or Asians generally are sort of equivocal between China and the US generally. I mean, they're realistic enough to realize that they're sitting right next door to a giant here, being China, and they've got to kowtow to some extent. Or I think if the choice was there, they much prefer to align with the US. But the US, therefore, has got to be a consistent and robust partner.
Hmm. There's been so much talk about diversification internationally. Are there parts of the investing universe, whether it's geographically or country, or that are in a better situation with their debt? Because I mean, we're so focused on the US because there's so much strain here, and we've seen strain in the bond market, and we carry so much debt, and the whole system, the dollars are so important to the whole system. But as you mentioned before, a lot of countries are in this situation. So is this sort of a race to the bottom for everyone, or are some places better situated that could benefit as people try to look around and look for the sort of cleanest shirt in the dirty laundry?
Well, I think there are. I mean, I think you can cherry pick. I mean, no names immediately come to mind in that regard, one would say. But the trouble is that those countries that you probably do cherry pick don't have reserve currencies, so it's kind of difficult to suggest them. I mean, one of the countries, paradoxically, that's in a great debt situation, Derwan mentioned it, is Russia. I mean, they don't have a lot of debt. They have a low income tax rate. I mean, a lot of the statistics Russia has, I'm sure many people would jump at in the West, but that's clearly not an investable country right now. If you look at Europe, Europe's debt dynamics look much worse than the US. The demographic situation is awful. They've got no access to energy, and we know they've got a whopping great defense bill to fund. So, the question I keep asking, looking at the dollar going down almost every day, is, why would you be putting money into the euro? I mean, the euro is certainly not an alternative, a robust alternative. And then you've got the other alternative, which is the other big component of the DXY, is the Japanese yen. Well, why the yen? Why should Japan be necessarily such a safe haven when it's sitting right next to China, which is, always looking back at the pages of history, always wants to gobble up or, be aggressive towards Japan. So the US, I think, in terms of those other paper units, still looks pretty viable. I'm certainly not persuaded that there's a sea change and a big exit of money out of the dollar. People just can't do that. There's really no alternative. The alternative is in gold, but then the gold market's so small that you can't really even use it as an alternative, really. If you can take it, but big countries can't. Their asset pools are just too big to
So that's so
diversify.
interesting because it sounds like, for all the sort of doom and gloom, and it sounds like, not from you, but just as dire as the situation is, because it sounds like, and correct me if I'm wrong, that we are on the cusp, we are in a capital war, and we are on the cusp of a financial crisis if the Fed doesn't step in and get together and US officials don't do something to provide liquidity. It sounds like you're saying we're on the cusp of things seizing up.
Well, I'm not saying that there's going to be a problem tomorrow. I'm saying that there are problems out there. And there was, the wonderful quote by Winston Churchill, who could say it because he was half American. He said that Americans always choose the right solution in the end after exhausting all the others. So I think that ultimately, I'm optimistic enough to know that it will work out. But the Federal Reserve has got to come up with some sort of plan about what it's going to do with its balance sheet. And I think that's the critical thing. The Federal Reserve has to play a role in the sovereign debt market and the treasury market in the longer term. It's too important to ignore.
Mm.
And I think ultimately Scott Besson is a bright guy. He knows how the world works, particularly the financial world, and I'm sure he will steer a solid path. I'm optimistic in that regard, and I think that, as I said, maybe right at the beginning, in terms of risk-off moves, only 8 to 9% of all asset allocations since 1978 have been more extreme in terms of bearish positioning than we've seen right now. So on an 18-month view, it's got to make sense to be putting money into markets. But that's an 18-month view. You may not want to catch a falling knife, but maybe if you're a trader, start to put money back. I'm that optimistic. But what I'd like is more clarity on the balance sheet and on the liquidity story, and that's what we focus on a lot. And I still feel unclear as we speak.
Mm. And so it sounds like everything is really going to be this, the Federal Reserve, and particularly the May meeting, is going to be really critical.
I think all the meetings this year will be critical. I think the May one, I mean, they're going to have to come out and say something. And if you look at the path of bank reserves or prospective bank reserves in the US through this year, which is one of the things that we project to try and work out stresses in the system, I mean, I think that the money markets basically hit a point around September where they kind of ran out of money. Liquidity really dries up. And a lot of that is because of the fact that you've got a lot of, toing and froing in the money markets right now. April 15th, clearly this is the tax paying day. There'll be a lot of money sucked out of bank accounts and out of the money markets into the treasury during that time. So there'll be an illiquidity period. Then we've got the rundown of that TGA as the debt ceiling continues. So that's another situation to take into account. And then you've got the TGA rebuild later in the year where, presumably the debt ceiling is resolved, but the Treasury will want to rebuild its cushion in the Federal Reserve. So it'll be taking money out of markets. So all these factors that make it complex, but what it adds up to is a situation by later in the year, September, there's a risk of the money running out. And the Federal Reserve's got to try and have forward guidance at least towards what's happening there.
Michael, this has been tremendous. I could keep asking you questions because it's so complicated, but I think you do an amazing job of trying to sort of break it down and make it translatable for sort of ordinary people who are trying really hard to figure out what to do with their money now. And I think there's a lot of fear and concern out there. So thank you very much, as always, for helping guide us through all the liquidity indicators that you look at.
Great, Maggie. Great pleasure. Enjoyed it. Thank you.
Thanks so much.